Hello everyone, welcome to How to Do Basic. In this video, we will see about CTC and its structure. We will also see about which part of CTC is taxable. CTC means cost to company. It is the total amount that a company spends directly or indirectly on an employee. In other words, the total salary package of an employee is called CTC. CTC is of many parts. CTC include gross salary and provident fund and annual components like gratuity, annual variable pay, bonus, etc. If you want to know more about PF and EPF, I have a video of it linked in the description. So coming back, CTC includes basic salary, travel allowance, house rent allowance, medical allowance, special allowance, and other allowances. From the above, an employee can claim tax exemptions on the following. He can claim tax exemption on HRA, conveyance or travel allowance, medical allowance, and other allowances. House rent allowance is the allowance provided by an employer to their employee as a compensation for the house rental expenses paid by the employee. It forms part of the salary paid by the employer to their employee. Employee can claim an exemption for HRA if they are paying their house rent. In case the individual resides in a metro city, then he or she is entitled to an HRA equal to 50% of the annual basic salary. For cities other than a metro, the entitlement is 40% of the annual basic salary. Conveyance or travel allowance. You can claim tax exemption for the amount spent on travel or commuting for a tax benefit of up to 1,600 rupees. Medical allowance. You can claim medical allowance by producing bills as evidence. The tax benefit is up to 15,000 per year. Other allowances. The government allows you to claim tax exemptions under sections 80C and 80D for specific investments, amounts spent on repaying home loans, or expenses such as insurance premium. Before making any TDS, an employer must obtain a declaration and proof of investment from the employees. There are maximum limits to the amount that can be declared for exemption. So which part of CTC is taxable for employees? Consider an example employee profile. His monthly salary structure is as follows. He gets a basic salary of 80,000. He gets an HRA of 40,000. He gets special allowance of 15,000. Leave travel allowance is 1,250 rupees. DA is not paid. Bonus, commissions or fees are not paid. Here, basic salary is fully taxable. HRA is partially taxable. Special allowance is fully taxable. Leave travel allowance is partially taxable. Dearness allowance is fully taxable. Bonus, fees or commissions are fully taxable. So except HRA and LTA, others are fully taxable. The employee has other income sources such as fixed deposit interest, which has an income of 5,000 rupees. And also he has some investments such as PPF of 50,000 and LIC premium of 9,000. Also, he has expenses such as a medical insurance premium of 8,000 rupees. So if we convert his monthly salary to annual, he gets a basic salary of 9,60,000 rupees. He gets an HRA of 4,80,000, special allowance of 1,80,000, LTA of 15,000, and here, as DA and bonuses are not paid, they are 0. So here in LTA, assume that he submits 11,000 worth bills. So out of the provided 15,000, the balance amount of 4,000 is taxable as per old regime. But as per the new regime, 15,000 is fully taxable. In case of HRA, if for example he pays a rent of 30,000 per month, there are 3 methods of calculating HRA tax exemption amount. The first one is what's his actual HRA. It is 4,80,000. So case 2 is like what's his actual rent which he paid over an year, and just minus it to 10% of his basic salary plus DA. So it makes something around 2,64,000. So case 3, 50% of basic salary plus DA, which amounts to 4,80,000. Here they are taking 50% as the employee is living in a metro city. If he is not, then they would be choosing 40% of basic salary plus DA. So the HRA amount which will be exempt from tax will be 2,64,000, as that comes to be the least of the 3 amounts in the scenario stated above. Now let us see about other allowances and how tax benefits apply. As per section 80C, the maximum deduction limit is 1.5 lakhs for eligible investments. So in our case, the employee makes a PPF deposit of 50,000 and LIC premium deposit of 9,000. So if you see our previous video on EPF, you would know about the contribution of employer in EPF and EPS. And here in our case, the employer contribution of 12% is also added as a part of other allowances, 1,15,200. Here it becomes 50,000 plus 9,000 plus 1,15,200, which equals 1,74,200, and out of this amount 1,50,000 can be claimed. As per section 80D, the maximum deduction limit for self is 25,000 and for parents it is 50,000. So in the medical insurance premium of 8,000 that he pays, he can claim the whole amount of 8,000.